Once a company knows it has historical exposure, what should it do first?
The first thing they're going to want to do is work with a sales tax expert to identify software that they're going to utilize to handle the compliance going forward, and then implement the software with that expert, and then work to map out an action plan to resolve any historical liability. And that could include registering in states to collect and remit sales tax going forward. It could include registration and back filings to clean up some of the periods where there's historical exposure, or it might include voluntary disclosure agreements with the states, and that's typically handled by that trusted advisor who's going to anonymously act on your behalf to get you registered and compliant with respect to historical periods in each of the states.
Is it ever too late to address historical exposure?
No, it's definitely never too late. Those liabilities, since there is statutes of limitations, which are the look-back periods that states can go back in time and audit registered taxpayers for, those periods, which are typically 3 or 4 years, they don't exist if you've never registered, never filed, never paid taxes. So states can go back as far back as they want to go, as far back as the taxpayer's established nexus, and typically that may be 8 to 10 years. And so the huge benefit of working with an advisor to help mitigate and address those historical exposures is that the states will limit your look-back period. And those opportunities to work with states, even if you are currently registered, they still exist. Many states will still allow registered taxpayers into their voluntary disclosure program, and other states, it's still found money for them. So they will, even if you don't fit within the formal program, they'll work with taxpayers and their representatives to work out a deal to settle and resolve those historical liabilities.
What's your approach when a new client comes to you with years of potential liability?
The first thing we're going to want to do is work on verifying their identity. So how would states classify who they are and what products and services they sell for sales tax purposes? We really want to understand. Oftentimes a company will come to us and they say, we went through due diligence, they identified us as a SaaS company, and we have this huge exposure. We look at it and we realize, well, some of your products may be SaaS, but others are not. They're perhaps non-taxable products or services. And that in and of itself, just understanding their identity and how states will classify them, can minimize a lot of the historical exposure. Then we're going to map their individual sales items to appropriate tax codes and import that stuff, all the transactional detail, into our sales tax software so that we can really drill down and quantify by state the historical liability, and at the same time determine when, if it's economic nexus, when they cross that state's economic nexus threshold. If they have physical presence, then we look at when was physical presence established. Armed with all that information, we know exactly when nexus was established and right down to each transaction how much liability we're talking about. And then we can really map out a game plan for how are we going to address the liabilities in each state. And that could be one of several things. That could be that we are going to register on a go-forward basis because the liability is fairly low, it's not an aggressive state. It might be that we're going to register and do some back filings to get them cleared up in the past, or it might be that it's an aggressive state and or the look back, the nexus look back is so large and the liability is so large that a voluntary disclosure agreement really makes sense in order to kind of truncate that look back period and minimize the liabilities, because one of the huge benefits with a voluntary disclosure agreement is not only the limited look back, but also that states will waive penalties and in some states even interest.
How do you prioritize where to begin when multiple states are involved?
So we're going to look at give you an example, we've got a state company and they've got 23 states with historical liability. We're going to look at the amount of liability in each state and kind of look at a return on investment. Obviously, if the liability in a state is only $2,000 and there's a cost involved in a voluntary disclosure agreement, you have to pay the state and you have to pay your sales tax advisor to represent you through that process, that may not make sense to pursue a VDA in that state. In that state instance, it might be that you register and do some back filings, or maybe the liability is so small that you're really going to roll the dice and just register on a go-forward basis. Other states, you're going to look at, how aggressive is the state? Is it a state that once you register, they're going to be monitoring your remittances and may very well send you a nexus questionnaire inquiring about pre-registration periods if your remittances every month or quarter are significantly large? What is triggering the actions to want to even address nexus and historical liability? Is it just that you're now trying to get compliant, or are you going through some sort of due diligence, an investment or a sale of the business where voluntary disclosures may be the only outcome that the investor or buyer is willing to accept? So we're going to look at all those things, what's triggering it. We're also going to look at cash flow. That's a really important thing, because when you're looking at 23 states where you might have historical liability, for example, the cash flow outlay could be so significant that it could be financially disastrous. So we kind of want to look at a mixed bag of all those factors and determine, okay, there's going to be some states where we're just going to register on a go-forward basis. There's going to be other states where we're going to register and do some back filings. And then there's going to be this other bucket of states where we're going to do voluntary disclosures. And then even within those VDA states, those voluntary disclosure states, we can look at ways to kind of stratify the states and take certain states in order of magnitude and then address maybe the next strata of states subsequently.
What factors determine the best path forward?
So like I said, if we're talking about voluntary disclosures and resolving historical liabilities, cash flow is going to be a very significant factor. We're going to look at how aggressive the state is and the likelihood that if you were to just register, they're going to find you. What factors are triggering this? Is it due diligence and the investor or buyer is going to require voluntary disclosure? Then we're also going to want to look at, there are really kind of two buckets of states that we would consider. There are those that, in order to pursue a voluntary disclosure agreement with the state, you can't be registered in that state. And so those, if we're going to do a VDA, today is the day we're going to do it. We can't register and then subsequently pursue that kind of thing, because the pure VDA option will be off the table. And then there are other states that say, no, if you're registered and you're even registered for sales tax and you have been for some time, we'll still accept you into the voluntary disclosure program. So there may be a bucket of states that we do VDAs right away, and others where we register, and then subsequently when those first wave of VDA states are done, we pick up the second wave of states and do VDAs in those states.
When does a voluntary disclosure agreement make sense, and when might it not?
Well, as I mentioned, like the amount of liability is certainly going to impact a lot of that. Is there an actual return on investment? How much is going to be liability is avoided? How much is saved in terms of penalty and tax avoidance by doing a voluntary disclosure agreement? How aggressive is the state? That's certainly going to be a factor. And then again, the what's triggering the move towards compliance? Is it just that you're implementing software and you want to implement a sales tax compliance process, or is due diligence really triggering this? And so those are the primary factors, and then cash flow obviously is going to be a very significant factor that's going to help drive how we organize the states and in what order we address each state.
How do you help clients balance compliance with the financial impact of remediation?
So I talked a little bit about cash flow. What we do with each of our clients, particularly when cash flow is significant, there are a large number of states and a significant amount of liability, we will work out kind of a cash flow plan so that we are really stratifying, as I mentioned, the states where you got to do a VDA and you'll get registered as part of it, or you can do a VDA subsequently after registering. And so those would be kind of two buckets of states that we would look at. And then we might kind of take one or two states with significant liabilities and address those VDAs first. We're also going to be looking at which states will allow some sort of a payment plan arrangement where there'll be a down payment and then equal monthly installments over the next 12 to 24 months, maybe even 36 months. That's always an option, but really not one that a lot of companies want to pursue because states are not banks, so their lending rates are really not good. Their interest rates are pretty high. So if there are other means of gaining that capital, then you really want to pursue that. But we'll kind of work out a plan to kind of stratify the order in which we're going to pursue each state to stretch out and kind of amortize the liability over several months and years.
Can you share a story where a client came to you feeling overwhelmed by years of historical exposure? How did your team help them work through it?
So the first thing we're going to do is ensure that if they already know there's a liability, we're going to ensure that we agree that that's what the liability is. So that starts with their identity, verify what their identity is. How would states classify who they are and the products and services they sell? Are they truly a SaaS provider, or maybe some of their products and services are SaaS, but others are non-taxable services that aren't SaaS, or maybe they're digital services, which may have entirely different tax treatment. So oftentimes we begin a conversation with clients that have one impression or conclusion already reached in their head, and it may have been one that another provider has already given to them, perhaps during due diligence. So they're assuming kind of this worst case scenario. And as we classify their products and services and map those and import their historical transactions into our software, calculate the actual liability, we start at a place that's already much lower than where they might have thought they were going to be in terms of the states where they have nexus and what the liability is. And then from there, we're going to map out that action plan for the states in which we're going to, the order in which we're going to address the states, and whether it's going to be VDAs in every state, or maybe some VDAs and some registrations and back filings. Maybe there's some smaller states where we're just doing registrations. And so we end up with an action plan that gives them a lot of comfort knowing that, okay, I can now see where we are and where we're going to end up and how long it's going to take us to get there. And we'll try and work with them to kind of stretch that out from a cash flow perspective in terms of timing the VDAs, timing the payment plans that are available, and timing when we start each VDA, whether it's VDA first or register and then subsequently pursue a VDA.
Have you ever had a client assume the worst, only to find out that there was a much more manageable solution?
Yeah, I think a lot of clients might come in assuming one thing, and then when they work with us, they realize, oh, okay, it's really not quite as bad as we thought. It's often not that clients assume there's nothing and are completely shocked to find that there is liability. It's more that they know they don't know, and they're very worried. And we work with them. We identify exactly what products and services they're selling, import those things, identify the actual liability, verify when Nexus was started in each state, and then map out that plan with them so that they can see, okay, it's a much more palatable liability. Any liability obviously is not going to be good, but we tend to work with them and get them to a place where they can see, okay, we see a roadmap to success here and compliance in each state, and we see how we're going to get there, and we see how long it's going to take, and we can kind of amortize this liability out a little bit. And we can also begin collecting the tax with the implementation of software in these states where we're going to get compliant, so that we can kind of stop the bleeding, so to speak.
If someone listening knows they have historical exposure but hasn't acted yet, what's your advice?
Contact a sales tax expert right away. I would not reach out to a software provider. I would first talk to a sales tax expert and understand exactly what your obligations are, and then work with that advisor to identify the right sales tax compliance solution for your business. They'll be able to help you implement it and then work with you, represent you through the resolution of all the historical liabilities, setting up all the states, and even managing that compliance for you going forward so that you really never have to think about sales tax again.